Hi, everyone, and welcome to the webinar. I'm Andrew Behar, the CEO of As You Sow, and I'd like to welcome all of you to do the investment math, building a carbon-free portfolio. This is the first in a series of webinars and reports to answer the question of how you can divest from carbon-intensive fossil fuel companies without significantly increasing your exposure to risk. Our intent is to offer a different narrative and set of assumptions to endowment trustees and fund managers, many of whom have contacted As You Sow in response to the call for fossil fuel divestment that's been sweeping the country in the headlines in the past few months. So I'm your moderator. I'm going to take you through some housekeeping first. I'll be giving a brief introduction to frame the issue. Then I'm going to hand it off to Dan Apfel, the Executive Director of the Responsible Endowments Coaltion. He's going to discuss the university divestment movement. It's grown to over 200 schools since the campaign was launched in 2011. Then I'm going to turn it over to Patrick Geddes, the Chief Investment Officer of the Aperio Group. He's going to take us through the underlying math and portfolio theory of the paper that he authored, Do the Investment Math, Building a Carbon-Free Portfolio, looking at a range of carbon-free index funds to track against the Russell 3000. We've reserved 20 minutes after the presentation for Q&A. If you have questions during the presentation, just type them into the chat window on the right-hand side of your screen. I think it says Q&A on it. And we're going to collect these and answer as many as possible. Also, we're recording the webinar, and a link will be sent to everyone who's logged in. So the webinar recording will also be available tomorrow, both on the Aperio and As You Sow's website. And if you have any technical problems, just use the chat window so we have a technical support person on the line who can assist you on a side channel. So let's get started. As You Sow is a nonprofit organization based in Oakland, California, dedicated to increased corporate responsibility. We focused on climate change and environmental health impacts of coal and hydraulic fracturing for the past 4 years through shareholder engagement with companies including Exxon, Chevron, Duke Power, Ameren, First Energy, and Consol. We see divestment as another tool in the process of shifting corporate policy, and we understand the pressure that many endowment trustees feel right now. Students, faculty, and alumni are demanding that they do their fiduciary duty and align their investments with their stated values and find a way to shift their portfolios away from fossil fuel. The commonly held belief is that moving into a carbon-free portfolio will increase financial risk and reduce returns. Today's webinar is going to dispute that concept and offer an alternative. A few years ago, in 2009, we started our work in the energy sector by publishing a white paper on the financial risks of investing in coal-fired utilities and coal mining companies. And this paper showed how the coal extractive industry was going to be heading into decline as coal plants closed and demand was reduced. In 2011, we joined with a group of other nonprofits to found the University Divest Coal campaign, and that started on 5 college campuses. And it grew until mid-2012 when Bill McKibben wrote his Rolling Stone article, and it quickly grew to about a dozen. And now after the recent 21-city tour, over 200 campuses have active fossil fuel divestment groups, and the concept is spreading across civil society, hospital chains, faith-based institutions, unions, foundations, cities, and pension funds. And we've been fielding a lot of calls from all these people who have been feeling the pressure from their constituents to make a move. So we developed this strategy because we believe that climate change is not just about commodities being burned and increased atmospheric carbon. Many people say that fossil fuels are the apartheid of this generation, and that climate change is a morally reprehensible legacy to leave to our children. What Superstorm Sandy demonstrated was real loss in lives and an estimated $60 billion in material damage. So with Wall Street literally underwater and storms of this scale expected to occur more frequently, the question is, how can the financial industry help to direct the needed shift and answer the call to action? Many people are saying that ExxonMobil is certainly not quaking at the idea that a few hundred universities might dump their shares of stock, nor would the company's stock price be likely to feel significant tremors. But the report issued by the American Petroleum Institute just a few days ago, making the case for university endowments to not sell their oil and gas holdings, clearly is responding to what it must see as a threat. But this movement represents much more than just divesting from stocks. It's really the crystallization of an important concept, that the extraction and combustion of fossil fuels threatens the human race and the planet. It asks if the business plans of fossil fuel companies are aligned with the future that we want to see. And we're finding there's a powerful voice in the generation that's demanding a clean energy future. And paradigms do shift. South Africa divestment movement was initially derided as ineffectual and naive, but in the end it helped to cast the apartheid government of South Africa as an outlaw. Philip Morris was once held in nearly every portfolio. Similarly, a broadly held belief that investment in fossil fuel companies is not socially responsible will move capital to cleaner energy sources. And this will have a serious impact, demonstrated in a Moody's report 2 months ago, warning that the rapid increase in renewable energy capacity in many European markets would seriously damage the credit ratings of coal and gas-fueled utilities in the near to medium term. So in conclusion, what we see is the powerful voice of a generation stating that the extraction of combustion of fossil fuels threatens the human race and the planet, that climate change is not something we can leave to our children, and that the alignment of mission and investing is a critical part of fiduciary duty. And the time to find a path forward is now, by responding to this market demand for carbon-free investment that will provide capital to build a new energy future. I want to thank our sponsors. You mentioned we're a nonprofit, and really want to thank the Wallace Global Fund and the Educational Foundation of America for support in this work. I'm now going to turn it over to Dan Apfel, Executive Director of the Responsible Endowments Coalition. Dan's an expert at supporting and implementing responsible investment strategies on campus. Dan?
Thanks, Andy. I'm glad to be here. So the Responsible Endowments Coalition was founded in 2004 to help universities implement responsible investment strategies and to advocate and to support advocates for responsible investing on campuses. So we've been involved in this campaign from the beginning with As You Sow, but now we're really excited. This campaign, as Andy mentioned, has now gone to 200 campuses. From Green Mountain College in Vermont with a $3 million endowment to the University of California system on the West Coast with over $65 billion, including its pension funds. This campaign has gone viral. It's all over the country, and students across the country are calling on their universities. What are these students asking for? These students are demanding, as Andy said, demanding that universities take real action on climate change, that this is not about just greening campuses, but that they look at their endowments and make the most powerful statement that they can by using their money to divest from fossil fuel companies and to reinvest in a new sustainable economy where they know that they and their children can live for future generations. As we know, money talks in the United States and around the world, but particularly here, and divestment, universities divesting is the most powerful statement that they can make, more powerful than greening their campuses, more powerful than buying wind power. So what do these students want? They want universities to divest. They understand that how powerful it is, and they understand that the college's mission is about sustainability, about educating citizens, and that really that climate change is a defining issue of our time for both folks that are running universities, but especially for the students that are in universities right now that benefit from these endowments. But these students also understand that the bottom line matters. They're on scholarships, tuition has been rising, but they know that they can have an impact and preserve their education and the education for those in the future. So they want to invest in this economy of the future. So universities really are looking at this and saying, how can we take action? Students are demanding it, and universities and administrators and the folks that they work with are responding. So what should investors do? And what are they doing? So consultants that are working with universities, investment managers that are managing the funds of universities, and particularly university investment officers and trustees have an opportunity to look for a future, to look for investments that are possible. At Unity College in Maine, they've decided that they're moving away from fossil fuels and that they're going to invest in the future economy. They've demanded, they've said that they're going to divest, and that their president is actually on the road speaking about divestment and how important this issue is to Unity College and to students at their school. At Hampshire College, they moved away from investments in fossil fuels and are particularly looking at how they can invest in the new economy, how they can invest in sustainable businesses and sustainable energy, and how they can bring students into that process as well, into the process of investing their endowment. At Swarthmore College, where students had first started this campaign in early 2011, the university is hearing their demands and is starting to examine what they can do, and just recently joined the Investor Network on Climate Risk, which is a big network of investors with trillions of dollars under management who are looking at how they can affect issues around climate change. And Middlebury College has decided to hold a set of forums examining the issue of divestment and whether it makes sense for the school. So they're looking at these issues too. So what do you do when you're looking at this and trying to figure out? First of all, the most important thing for a university is, of course, to figure out the financial risks. And that's why we're here today, because unlike what many of us might expect, the financial risks of divesting from fossil fuels actually turn out to be minuscule. Not only, as you'll hear, are they very small for an equity portfolio, for stocks, but equity portfolios only make up 40 to 50% of university endowments. So then, once you know that you can do this and that it's possible, it's time to prepare your portfolios and think about the future. And realize that it's not just about divesting from fossil fuels, but looking for all of the alternative options out there for your investments and also for investing in a new sustainable future for your students and for future students and for future generations. Investing in the new energy of and new communities and sustainable communities, and moving your capital to support the things that are going to support our environment and our world for the next generations. Thank you for giving me the opportunity to speak, Andy.
Thanks, Dan. And so now I'll hand the control over to Patrick Geddes, CIO of the Aperio Group, a financial advisory firm that manages customized portfolios for a range of value-based investors. Prior to joining Aperio, Patrick was the CFO and Director of Research at Morningstar Incorporated, and he also spent 5 years as a financial analyst with Ameco, which is now part of BP in the U.S. and in Europe. Patrick?
Thanks, Andy. And as Andy mentioned, my job here is to talk about the investment math, which is a rather dry and dispassionate topic, but it is brought up in the middle of what is actually a very passionate argument, as we've heard for some advocates on the side of divestment, as Andy also mentioned, or Dan also mentioned, the American Petroleum Institute issued a paper last week touting the excellent returns from that industry. There's a lot of heat and emotion. In my voice, I'd like to be one of neutrality. In terms of divestment, I'm neutral on that issue in terms of neither actively for nor against, but I am against distortion of financial mathematics, and I am against bad investment math. And so we will talk about that in more detail. I'll talk about the American Petroleum Institute paper at the end of my time. So what am I going to talk about? It's basically I want to set the record straight on that, and the other point I really want to cover in my section is that you have to do the math and that's getting left out of the conversation. So we'll start with the different ways investors can incorporate their values. There are a lot of different approaches investors can bring to incorporating values into their portfolios, and we'll go through some of those to varying degrees of intensity. What we'll really look at is the fact that when you start addressing the portfolio, the tighter the restrictions, you do start affecting the risk more. And for that, we'll be getting into the investment math. And the important issue is this idea of it's very, very important to measure something we're going to call tracking error, and we'll be defining that. And the reason that's so important is it's so easy for skeptics, either in the financial services business or on endowments, to dismiss screening as a well-intentioned but rather silly exercise that basically means you're lowering your return and you're suffering from a tax on your investment returns. That's actually false, and what I want the conversation to be going forward is when someone says that, you need to ask, really, have you quantified that? Have you actually measured that? And we're going to go through that, and we're going to go through a sample back test as well and address the American Petroleum Institute paper. All right, let's turn next to some different ways investors can incorporate values into their portfolio. And we're going to be going from left to right, more intensely green, starting with doing nothing. So no environmental values, no negative screens, no positive screens, not doing anything on the proxy voting side or advocacy. So this is the status quo. Now the lightest version of becoming more engaged in terms of one's values is to still do nothing on the actual portfolio, but instead take action through proxies and shareholder engagement, similar to some of the programs As You Sow engages in. And that has, of course, no risk impact on the portfolio, but is doing something in the direction of engagement. Now let's move to where we actually start including some screening, and we'll start with our first example, what I've called a very mild negative screen. This is limiting holdings in a U.S. stock portfolio that exclude what are called the filthy 15, and that's a list of 15 stocks judged by As You Sow and the Responsible Endowments Coalition to be the most egregious polluters in terms of coal, both production and burning. Now, this is a rather small list, and what we're going to focus on through the rest of this talk is this tracking error issue. In this particular case, a very slight version of only 14/100th of a % of additional risk. And we'll get into more detail of what that actually means. So let's get a little more strict in our screening, and that's a full carbon divestment. So this version says let's actually exclude the main carbon industries. This would be oil, gas, and consumable fuels. And that introduces more tracking error. That's going to introduce more risk. Now we're up to 60/100th of a %. So we'll see in context that's not actually that much. And you may have endowments that want to go further. Let's say they want to overweight sustainable industries and therefore go even further on a green portfolio. That's delivering slightly higher tracking error. And finally, the greenest one we'll look at is where endowments or investors may want to go beyond just publicly held companies and actually reinvest funds from divestment in both public and private equity. So that's the greenest portfolio. It's also got the biggest impact on risk and return. The basic conclusion of all these choices is, what's the right choice? That's a decision for investors and endowment boards to make on their own. There's no obvious automatic answer, but there's a wide range of paths to take. All right, let's turn now to the actual math. So the science of climate change requires one kind of math. I've just got a little graphic here showing temperature change over time. But the investment world requires its own version of math, and I think that's been left out of this passionate debate. What I'm showing here is the formula for portfolio risk. And that's where we're going to end up focusing most of our time because it's the easiest component of investment performance to measure and predict. So why don't we start first, though, with returns. That's obviously the thing most investors care about. And on that score, there's been a lot of academic research with some very mixed results. What I'm showing here, this report over on the right, Demystifying Responsible Investment Performance, that was published by the United Nations. It looked at about 20 academic studies. I think they found around 3 said that there were negative return impact, about 7 found it neutral, and about 10 found it positive. I would say that's mixed, and that there's a lack of evidence that returns are higher, which may be a disappointment for people pushing that argument, but there's a lack of evidence that they're lower. So results are that there's not much impact on the return side. That's That's consistent with a lot of portfolio theory. But where does that leave us? Well, if we're neutral on returns, it means now we need to focus on risk, because after all, portfolio theory is about investors getting compensated for the risk they take. The problem is that a good metric has been missing, and this is the part that has just been left out of this debate. What kind of metric do we need? Well, historically, within the investment industry, investors rely on two main statistical measures of risk. The first one, absolute risk, and that's basically the volatility of a portfolio or an individual security. That's how much it goes up and down, and that is the thing that people find costly because emotionally as investors we don't like bearing that risk. The second kind of risk is called tracking error. That's a comparative risk measure that says not that you're going to be going up and down a lot, but that you're going to deviate from a particular benchmark. We're going to look at a U.S. stock portfolio example later. We'll use the Russell 3000 as the benchmark, like the S&P 500. Russell 3000 is a good overall U.S. stock index. And the stricter the screening, the higher the tracking error. That's what we saw in some of the examples we were going through. Now, the theory says you should get paid more for bearing more risk. And if we're return neutral, then we may be adding tracking error and, in fact, absolute risk that we're not getting paid for. And what we need to look at now is, okay, what's that really costing us? But first, let's have a slight digression on what is this tracking error. Well, tracking error, as I mentioned, measures variation around a benchmark, and this is the statistic we need. So I'm using an example here of a couple of dartboards. The one on the left represents a portfolio with low tracking error. Now let's assume we're throwing darts at this dartboard, and that will represent, let's say, historical monthly returns for a particular portfolio. So what does a low tracking error portfolio look like? It looks like this. You can see these yellow dots. It's tightly clustered around the target, the bullseye, which is the benchmark. So on average, the darts are close to the target they're trying to hit, as opposed to a high tracking error portfolio where it's all over the dartboard, and that's a lot wider variation. You may still be on average tracking that target, that center bullseye, but it's much more widely varied. And so what are the characteristics of tracking error? Well, when we're using an indexing approach, which we'll look at in a minute, the tracking error has an expected value of 0. So error kind of sounds like a bad or pejorative term, but actually it's just measuring the precision of the predictability. How likely are we to hit our portfolio? And theoretically, half the time it'll be positive and half the time negative. All right, let's turn now from the theoretical measurement of risk to actually building portfolios. And we're going to, as I mentioned, take advantage of the benefits of indexing. Indexing, very cheap way to invest. Great for investors, not necessarily great for investment managers. It's also very transparent, very clear what's going on, and very easy to tweak or adjust to reflect a particular kind of screening, as we'll be looking at. So the examples we're going to go through are based on what's called a multi-factor risk model, and you see this sort of ugly-looking equation is what a multi-factor risk model looks like. The basic idea is use computer software to get a portfolio to look as close to a benchmark as possible, or like what an index fund would look like. So the goal here is we want to minimize that tracking error subject to whatever constraints, for example, throwing out the filthy 15. On the return side, the goal is to deliver market returns, but we've got this tolerance band as represented by the tracking error. And I don't want to imply this is some magical thing that's only very rarely available. This is widely available. Many indexing firms can offer this kind of service. All right, so let's go back to our choices and drill down a little on these three examples. So we've got the mild negative screen. We're going to look at that 0.14% tracking error. The full carbon divestment, that's where we kicked out the entire industry. Or the positive screen where investors may want to overweight, the greener of the three. And as you see, we've got a range of tracking error here. But what we need to do is actually convert this to portfolio incremental risk, because that's the number we really care about as investors. That's the thing that upsets our stomachs when we have to ride the roller coaster of markets going up and down, as we all saw 4 years ago when we were in the middle of that great meltdown. Okay, so this graph shows our three portfolios going up in terms of intensity of screening and increasing tracking error. So the blue bar represents the tracking error. Now I wanted to give some perspective here, and so I've included the average active manager. This is stock pickers who are trying to beat the market. On average, they're adding about 5% tracking error. So we're showing both the tracking error number, but also the actual incremental risk. And the math ends up getting you a much, much lower incremental risk than the tracking error would imply, because the incremental risk is the actual impact on the portfolio. That's the thing that investors may find painful. So how bad is it? Well, the filthy 15, the actual incremental risk an investor would face is 1/1000th of a % of extra risk. Now compare that to our average active manager of just under 0.7%. This is, I've called extremely low level of incremental risk. I'd say statistically this is basically noise. It's virtually no impact at all. Why? Because it's such a small number of companies to exclude. What if we go a little more seriously with the full carbon divestment? This is eliminating all oil, gas, and consumable fuels companies, all the stocks in those industries. That still triggers just 1/100th of a % of extra risk. So I wouldn't claim that has no impact. It's even hard to see the actual measurement in the graphic because it's so tiny. Very, very small impact on actual incremental portfolio risk. If you want to go further and do the positive screening, still only 2/100ths of a % and still 30 times less than the average active manager. So what's all this prove? Does this prove you should include screening? No, it proves that when you actually measure the impact, it's far, far less incremental risk than may often be assumed. Okay, so we've looked at measuring risk. We've looked at building a portfolio using these multi-factor models, and we've seen how much expected tracking error they create. Now let's turn to looking at how such strategies would have performed in the past. And we'll do that simulating historical performance using the same multi-factor models we used to create these portfolios. And what kind of results are we going to find? We'll look at the data in a second. I'll give away the punchline. For the U.S. market, there was very slight observed positive tracking error over the past 25 years. In other words, a portfolio excluding oil, gas, and consumable fuel stocks was slightly ahead. Now, I want to mention a caveat here. The SEC likes to insist that folks in my profession make the statement, which is quite valid, past performance is no guarantee of future results. Well, that's particularly true of back-tested data. So the technical statistical term is you better take this with a grain of salt. But the danger here is cherry picking. And one of the problems in the way investors look at historical results is a tendency we all have to go to the data that supports our point of view. And that's one of the problems with this analysis and why it's superior to actually just measure the risk, because you avoid the problem of cherry picking. Let's look at the example of cherry picking. So here is a graph showing the return difference over 10-year historical rolling periods between a portfolio optimized to track the Russell 3000. So basically a U.S. stock index fund without the oil, gas, and consumable fuels stocks. Now, as I mentioned, it's slightly ahead. You see that right here at a 0.08%, an 8 basis point benefit, which I think is more important to how small that is rather than the fact that it's positive. So how often was it ahead? And by the way, this is all the data we had in our model. This was not a cherry-picked example of history. If you went back 40 years, you may find on average that it was slightly negative. I would not be surprised if that were the case. So in our 25 years of history, these 10-year periods, 73% of them were ahead and 27% were behind. I would not consider that indicative of the future. What you should expect would be more like 50-50. Remember, we identified the tracking error as 0.6%, and the actual observed variation around the benchmark was slightly higher at 0.78. So in other words, the models we're using to predict are pretty accurate when you go back and test them. All right, now let's turn to the cherry-picking debate. So if you are tasked with picking a particular time period to make oil companies look better, which time period out of all of these rolling 10-year periods would you pick? Well, no big surprise that the American Petroleum Institute paper focused on the last 10 years, this kind of area on the graph where the portfolio we built and are looking at here actually did underperform for the not just the trailing 10 years, but all the 10-year periods basically from 2009. So more like a 13-year period. It was basically having oil out of your portfolio was a bad thing. However, what if, for example, you take the opposite tack and you're arguing divestment is going to generate a higher return? Well, which period makes oil companies look worse? Well, the answer is you'd probably pick something in the 2005 to 2008 range. That's where portfolios that excluded oil company stocks look better. All right, so now we'll have a little multiple choice quiz here. We want to predict the future in terms of the impact of excluding carbon companies from portfolios. Is it better to use this time period or this time period? Which is better? And the answer is C, none of the above. And that's because picking a particular time when oil either outperformed or underperformed is not very indicative. Going forward, the best way is to look at the risk impact and that tracking error. Now, I want to make clear, I am not here to malign the oil industry. I am here to malign distorted mathematics. And as Andy mentioned in the introduction, I spent 5 years as a financial analyst for a big oil company. And I don't know how representative it was of the industry, but the quality of financial analysis was very, very high at the firm where I work. We did really, really good financial work. And frankly, the study from the American Petroleum Institute, that would not have passed muster if I were going before a committee to approve any kind of a study, because it smacks too much of cherry picking. All right, so that's the basic conclusion on the American Petroleum Institute study. Is not that it was factually inaccurate. That I'm sure their data were quite valid. It's the dangers of picking just one particular time period. And the goal going forward, as I mentioned earlier, is that investors need to look at what is this actually going to cost instead of responding to a kind of knee-jerk reaction of, well, this is a tax on investing. So do the math. That's the important thing to know here. when investors are looking at this question. There's a range of choices here. You can do less strict screening. You can look at just the getting rid of the filthy 15. That one is so small a tracking error, so small a risk impact. It's effectively anyone who won't even go that far is basically saying, I just don't want any screening at all. And what I would say to the American Petroleum Institute paper authors is, you can come out and criticize doing screening at all. You just think it's got no place in a portfolio. But be honest about the actual picking of the historical period. Overall, the back test, no penalty seen. I wouldn't hang your hat on that going forward. What I would hang your hat on is over time, it's going to be a very mild impact. You might have a few years where it's ahead, a few years where it's behind. What's false is to assume it has to cost you return. That is not justified at all. So the next time you hear that dismissive comment, all you have to do is ask, all right, what do your measurements say? And those have been left out of the debate. So that completes my formal portion of the presentation. I'd like to turn it back to Andy.
Well, thank you, Patrick, and I see, and thank you, everyone in the audience. We have lots and lots of questions just been flowing in throughout. So I'm going to just start off with, let's see, one, there's many questions around, does a lower tracking error mean less volatility? How is it different from absolute risk? I saw that from many different people. So why don't you handle that one, Patrick?
Sure. So the tracking error is the dartboard analogy. It's measuring how close are you to the benchmark. So think of it as variation around a stock market benchmark's return. So it is a measure of risk, but it's different from absolute volatility. Absolute volatility is simply how much does my overall portfolio go up and down, and that incremental risk we're looking at is you are making, with extra tracking error, you are making the absolute volatility slightly worse, but it's a very, very small component. So the first one, tracking error, is variation around a benchmark, and the second one, absolute volatility, is the overall variation of the entire portfolio. And that's the part that investors don't like to bear that extra risk, especially if they're not getting paid for it.
Okay. Thank you. So let me see. A lot of them coming in. Let's see. Does the full carbon divestment category also kick out coal companies?
Yes. The subcategories, I believe, there's an oil production and oil, more retail, gas production, and coal mining.
Okay. Here's a combo of 3 questions relating to the active manager data. What does the active manager represent? Is the average active manager a representation of fund managers at universities, and more specifically, the incremental risk for the average active manager on one of your slides at 0.694? What's that number being compared to?
So let me start with the source. The 5% average tracking error came from a survey by an investment manager, GMO, out of Boston. And they'd surveyed Mercer and some of the other large pension consultants on what's the average tracking error, or in other words, how much does your average active manager plan to deviate from a target benchmark? So 5% is fairly high. The reason I included that is because it represents the starting point for many endowments. Now, the version we were looking at on the carbon screen portfolio is based on indexing, which assumes you cannot outperform. Obviously, the only reason you take that kind of tracking error is if you think you can beat a benchmark. So the 0.69 was the same math to convert tracking error to absolute volatility that I used with all the other the green portfolios. So for hardcore math geeks and investment folks, this will get a little technical, so cover your ears if you're bored silly by that stuff. You have to convert the standard deviation terms to variance because you can add variance terms and then you convert it back to standard deviation.
Okay, here's one for Dan. The investment math shows that there's a minuscule potential of additional risk from carbon divestment on the equities portion of the portfolio. How much does carbon divestment add to a total portfolio risk?
Well, so a typical, and Patrick can address this also, I think, but a typical university investment portfolio is between 40 and 50% in equities, and a little bit more than half of that is in U.S. equities. So you can apply the amount from that Patrick was discussing to particularly the equity portion of the portfolio, so less than 50% of the portfolio, depending on the school.
Okay. Here's one. I'm a student at a college with $1 billion endowment. Our board has told us that divestment will be impossible since the college does not invest directly, but rather through commingled funds. How can divestment occur when assets are in these pooled funds?
Sure. So can I answer that one, Andy?
Please.
So this is a very common question at universities. Many universities, especially those that are sort of on the smaller side of endowments, $1 billion, and not the smaller side, but medium size and under, about $1 billion and under, are very typically invested primarily in commingled funds, which means like mutual funds. Their money is mixed with other investors. So in that case, there's two options. The first is that you can encourage your mutual funds and fund managers to divest themselves, which is often difficult but is possible. And then you can also change managers or change the way that your accounts are structured so that you are able to divest and sell these particular securities, which is a more typical way of doing it.
Patrick, did you want to add to that? I know you jumped in earlier.
No, it's a question of if there's enough demand for commingled products. Right now, it's easier to get through separately managed account. My guess is if this movement really starts to develop the kind of momentum we're seeing so far, that will probably come to pass fairly soon.
Okay. What about an oil and gas company that also invests in renewables?
Why don't I take that one? One of the criticisms of environmental screening is that different people may interpret environmental, greening differently, such as, is this just after the producers, is it more the users? What's possible with the approach we looked at here is to actually convert it to reflect a really wide range of environmental screening and to incorporate the oil and gas. And what was the particular point they were?
Oil and gas companies that also invest in renewables.
Yes, there are data available on companies that may have renewable energy. So you could score, for example, we've got some data on energy companies that produce in sustainable ways. You could add those back. So there are a lot of different variations. The version we looked at was just focusing on the simplicity of a simple exclusionary screen rather than raising the very valid point. You see it also in utility companies. What about those that are focusing more on cleaner fuels to try and include that scoring? It's very easy to do in a multi-factor indexing context.
Andy, can I answer that also briefly?
Yeah, go ahead.
So I think something that's important to look at here and understand is that carbon and greenhouse gas emissions are important when we're looking at climate change. And an analysis from the carbon tracker showed that we have to keep most of the carbon that's underground, keep it underground in order to prevent going over 2 degrees of warming in the next century, which the World Bank and others have said is sort of and agreed upon. Is agreed upon by many nations as we must meet that target. And so divestment activists who are calling for change, and particularly what Bill McKibben and 350.org have said, is that fossil fuel companies should transition away from fossil energy and move to renewable energy, and agree to only extract and burn 20% of their current existing reserves. And if all the reserves that exist currently, if we burned only 20%, it's estimated that we'd be able to keep the Earth's temperature below 2 degrees Celsius increase.
Thanks. I'm going to take this next one, which is, would you say that shareholder activism is a better way to encourage positive change than screening? It seems someone will always be willing to buy your shares, even if many others are willing to divest. And as you said, we are actively involved with shareholder activism at most of these major companies, Exxon, with Chevron, with Consol right now. We have a shareholder resolution on exactly what Dan was just talking about, which is stranded assets and the carbon bubble. So we believe it is very important to keep that shareholder voice very loud and very strong and talking about risk. We see that divestment is another tool that can happen simultaneously, and we're seeing that the companies are hearing that from, particularly I think when alumni get involved at universities, and they're the folks who are saying, I'm only going to give my university a gift if it's restricted to not go into carbon. That's something the universities are hearing, and that is a very, very powerful message. So the fossil fuel companies are getting it from multiple directions. They're seeing that they need to come about change. They see that risk is increasing. So we see these as multiple tools that need to be engaged simultaneously. And so I think that's very important. Let's see. Next question. How far does definition of oil companies go? Include, for instance, equipment related to industry. What about oil-based products? You might have already.
That's actually a very interesting question. Again, it reflects the flexibility of investors can define that how they want. The oil services, the support firms were included in the carbon divestment version we showed. In fact, that's the only industry within the energy sector that was still included. And different investors may have different preferences of how rigidly they want to draw those lines. The point of showing all those variations was there are a lot of different ways to slice the data and to slice your definition. The goal is just always look at the tracking error. The more strictly you screen, the higher the risk you're introducing. That's the basic message. But you can do it. You can incorporate any version that people have been asking about.
Okay. Here's another one. Divestment adds a very small amount of risk compared to indices like the Russell 3000 or presumably the S&P 500. What if our college endowment outperforms the S&P 500 by a significant margin? Are these risk estimates still applicable in any way?
So that's basically a question around the debate between, or the choice between active management and indexing. And the data I showed are predicated on the overwhelming evidence that as an industry, active management does not add value. I don't think there's a whole lot of debate on that. There is debate about whether the best active managers do. So for endowments that are outperforming and confident that they will continue to do so, and the numbers are actually being measured accurately, that would be a reason not to pursue an index-based divestment policy. So the assumption of excess return is a different one from what we were discussing in the measurement, but it's valid in the sense that if you're going to earn active positive return, what's called alpha, then that is not presumed in the models we were looking at, if I answer that question rather convolutedly.
If I can take it also just very briefly, I think it's important to know that a lot of studies have been done of responsible investors, and a university that is able to outperform with active managers should be able to talk to those managers and they should be able to outperform whether or not they're invested in oil and gas and coal stocks.
Here's one. I'm working with religious institutions, most of which invest through commingled funds. Are there successful past examples that I can draw on which these commingled funds, whether mutual funds, TIA, CREF, or others, were successfully forced to divest? Anyone?
I guess it depends on how you define successful. I would define successful as not being penalized, and there are examples like TIA CREF has a screened mutual fund with a broader social screening, but they use the same methodology we looked at here. They used an optimizer to get back to the benchmark as tightly as you can. So I think it all depends on how you define successfully. There are a number of screened vehicles available through pooled either mutual funds or some institutional product. I think it depends how you define successful.
Okay. Short sale strategies are never brought into this discussion. Where's the long-short market neutral strategy, and why is it not deployed more often like this? Long carbon, free, short carbon?
So long-short is basically more of what is traditionally called the alternative space or hedge funds. And so you can do this version with a long short or a market neutral. It's one of the least available areas in the asset class arena for any kind of environmental screening. So it is available. It's not my expertise. I think it's pretty rare. My understanding when I'm looking at fixed income, private equity, public equity, hard assets, and alternatives, that alternatives tends to be the one with the least availability of environmental screening. So where is it? I'm not sure if the demand isn't out there or the managers aren't supplying it. It tends to be the least available in the marketplace.
Here's one for Dan. What happens to the tracking error to start layering on multiple issues as part of the screen? For example, students want carbon divestment, and we are hearing from trustees, and they also want weapons divestment. A few years ago was Sudan. How much can we divest before we lost the risk controls demonstrated here?
Well, I can. This is Dan. I can address the theoretical behind that, and I think Patrick is better positioned to identify the actual risk. But I would say that one of the important things to remember about divestment is that while it's important to say we don't want to make money from these things, that universities have endowments and they are trying to make a return. And so divestment is typically most powerful as part of a large movement. So it's most powerful when lots of institutions are doing it and lots of groups are making the statement with their money. So the Responsible Endowments Coalition, we believe that divestment should be utilized especially in places when there are lots of different institutions doing that so that it can be most powerful.
And then on the math side, it's a very valid question. It just all comes down to tracking error. So it's not so much the number of issues as how significant are they. So let me give you an example. Someone mentioned weapons. So let's actually take a subset of that, just looking at handgun manufacturers. In the U.S., handgun manufacturers are a very, very small component of the overall weight of the public equity markets, and excluding them is almost irrelevant. So something like a filthy 15 excluded portfolio and no handguns is very, very minor tracking error. You could have, I think part of the question is really about, at some point, don't you start stacking on so many issues that the risk starts getting affected? And the answer is yes, but that can be within a single issue or across multiple issues. And that's why the whole point of my argument is bring it back to measuring that risk. And if the question is, isn't there a risk level above which it becomes much more serious in terms of the impact on the portfolio once you're up at, say, a 3% tracking error? And I would agree absolutely. But the important thing is not to focus on the number of issues, but the intensity of the impact on the tracking error.
So we only have about 2 minutes left, so I just want to let everyone know who's on the call that the presentation, a PDF of the presentation, and the paper, and a recording of the webinar are all going to be available tomorrow on the As You Sow and the Aperio website. And other data is also available from the folks at Aperio. You can email info@aperiogroup.com. We're going to take one more question and then kind of close it out, but just so everyone knows that anyone who's logged in will be getting an email with that information. Let's see. Also to know that this is the first in a series, that we see this as being a really important question to keep discussing, and that we're going to be working on additional reports that's going to be looking at comparing different mutual funds that have screening. We're going to be looking at private equity markets. We're going to be looking at debt. We're going to be looking at green revolving funds and some other alternatives that, how universities and other groups in civil society can reinvest their money. So this is an ongoing conversation, and we just want to let everybody know that. So you know what, we're actually really out of time. And so I think I'm just going to wrap it up and just thank Patrick and thank Dan and thank the Aperio Group and Rec and everyone who's been involved in this, and also thank our audience for attending. Again, I just want to thank our sponsors, the Wallace Global Fund and the Educational Foundation of America, who supported this work for many, many years, and truly appreciate that. And I think we are out of time, and so thank you, everyone. We will be in touch by email with follow-up, and we will be inviting you to the next in the series.
And ladies and gentlemen, this concludes today's conference. Thank you for joining us, and you may now all disconnect.